Welcome back, guys, it's Nosh. If you haven't already done so, be sure to check out my part 1 on tax and real estate video. It'll certainly provide you with the basic foundational knowledge when it comes to real estate and taxes, so that we can build on that foundation in this video. Now with that being said, let's get started. Now we're going to talk about some of the tax incentives to owning real estate. Of course, there are tax incentives to owning real estate in Canada. Remember how I talked about a business and the tax incentives are just the amount of incentives to want entrepreneurs and people alike to start growing their business and start up a business, thus creating more jobs. Real estate is quite similar, and though we don't share the same tax advantages as our neighbors in the South, we still have a few that we can utilize. By now you might be thinking, well, geez, owning real estate for investment purposes doesn't seem all that attractive anymore. I promise you it gets better. Speaking of which, we might as well dive into the plus side of owning investment properties. As already mentioned, real estate investing is considered a viable business in the eyes of the government. After all, you don't purchase an investment property to lose money. Now, you remember the CRA's definition of a business? An activity that you carry out and can show a reasonable expectation of generating a profit. Now, based on that, you're considered to be self-employed. As a self-employed businessman or woman, you're able to take advantage of the small business tax deduction. The following list is not exhaustive, but it includes some of the deductions made available to real estate investors. Let's talk about salaries. Reasonable salaries that are paid to either you, your spouse, or your children in exchange for their services are considered to be tax deductible. They must be actively engaged in the business, and the salary is what you would have paid a third party to perform the same service. So in other words, you can't necessarily pay your child $80,000 a year to mow the lawn. Splitting income amongst family members is one of the easiest and surest ways to reduce how much taxes you're paying. So if one spouse is earning more than the other, instead of paying all the additional money in the higher tax bracket, by splitting that income with the lower income earning spouse, that money is paid in a potentially lower tax bracket, thus allowing you to shelter more of your income. So what might this look like? Well, let's suppose you generate $50,000 in profits per year from your rental properties. Supposing your spouse is unemployed and the both of you determine that your spouse will carry out the property management requirements for your rental properties, provided that the fees are comparable with that of hiring a professional property management company, a salary can be paid to your spouse, which lowers your annual income through income splitting. Similarly, supposing you have your son or daughter take on the responsibility of landscaping. You can pay your child the appropriate fees of a landscaper for lawn maintenance and snow removal. Now, this may have been a cost that you would have incurred regardless of whether you paid a professional company or not. Therefore, it's considered to be a tax deduction. Now, your child may not be a top tax bracket earner, and therefore the amount of taxes on the salary earned is less than what you would have incurred if you retained such profits by doing it yourself. Now, there's a form issued by the CRA known as the Statement of Income and Expenses, which outlines some of the expenses that one may consider deducting from their taxable income if the expenses is in fact incurred. It's worthwhile mentioning that if you own your own home, either your principal residence or where you live or a rental property, the property is building up equity over a period of time. With my principal residence, 3 years after I bought it, my home went up in value by $250,000. Now, since the government doesn't tax you on the profits you made up until the time you dispose of the asset or sell the property, if you were to pull out the equity from your property, you're not considered to be selling your property. You're simply borrowing against the likely profits you would have received if you sold your property. Now, this is huge. It means out of the $250,000 I made on paper, without selling my property, I was able to withdraw $200,000 in equity. That's bringing numbers from paper to physical dollar bills in my hand. Again, because I didn't sell the property, there's no taxes to be paid. So I was able to then reinvest that $200,000 into another property by putting 20% down on a property worth up to $1 million. So now think about that. That's equivalent to me earning $200,000 in that 1 year and not paying taxes on it. And even better, the cost of borrowing, i.e. the interest charged to me on that $200,000, was for business purposes. So it's considered to be an expense, i.e. tax deductible. As for the $1 million purchase property, the interest on that, if it's a rental property, even that's considered to be tax deductible. Now, those who don't own real estate and those who perhaps rent instead are unable to make use of any of these strategies to grow their wealth and instead continue to pay tax on every single dollar that they earn through employment income. This is another reason why injecting your money into real estate and then being able to leverage your money to invest further makes investing into real estate such a good investment, especially when it is done long term. Let's talk about some of the home office expenses. In the event your principal place of residence is also where you have set up your home office, which is quite likely, you're eligible to deduct a portion of your home office expenses. Deductions are all based upon the percentage of space used compared to the entire home, and allowance must be made for a personal component if such applies. Take for example this room behind me. This is my home office. I use the computer in this office room for construction and property management related activities. It would be fair to say that 100% of the items in this room are business related, as opposed to being personal in nature. Even so much as the artwork on the wall was purchased for the business environment and the business room as opposed to my own personal use. Now, let's suppose that I calculate the square footage of this room to be 250 square feet, and the square footage of my house, for number's sake, let's say is 1,000 square feet. Now, because this room is solely used for business purposes, I can take 25% of my utility bills and write it off as a business expense against my personal income as a sole proprietor. Now, I have internet in my house, and 25% of the time that I'm using the internet, it's for business-related activities. So I can deduct 25% of my monthly costs of my internet bill. The phone I use, 90% of the time I'm on it, is related to business calls, and therefore I can deduct 90% of my phone bills against my personal income. Things like this desk, the shelves behind me, many of the books on the shelf, etc., are all business in nature. There's no personal component to it, and therefore 100% of the costs associated with acquiring such furniture can be written off against my personal income, even so much as my fancy envelope opener. The desktop computer in this room is only used for business, and therefore that can be written off against my personal income too. Now, what if I use the computer to also watch movies and, let's say, check personal email and perhaps surf online for good cooking recipes? I would have to calculate how much personal use of the computer there is, and how much I use the computer for business. Stationery, printer ink, blank paper, insurance, maintenance, cleaning costs. Now, some depreciable home office items include your desktop computer, your home office furniture. Depreciable items refer to items that lose its value over a period of time, things that don't get used up, so to speak. So a pen would get used up, and therefore I can write off my stationery on an annual basis. My computer, however, is likely to last me more than 1 year, and therefore I have to depreciate it over a period of years. Now, the CRA will have certain classes which deem how many years it would take to bring the value of your, let's say, computer from how much you paid for it to worth nothing. So let's assume your computer cost $1,000. If you use this computer 100% of the time for your real estate business, you would be able to write off the entire cost of your computer over the course of 4 years. This would amount to an additional $250 in tax-deductible expenses for each of the 4 years. In some cases, the government may issue an incentive and allow you to write off the entire expense in just 1 year. So this means that there are years where it's more advantageous to purchase such equipment like a computer if necessary as compared to other years. It's something to look out for. Now, compare an advantage like this to someone who doesn't own investment properties. They're likely paying for their computer expenses, their internet, etc. with after-tax dollars, i.e. their disposable income. You, on the other hand, having a rental property, use those expenses to lower your total tax burden, ultimately paying for such expenses with tax dollars instead. This same rule applies to all tax-deductible expenses. Now, it's important to note that the expenses you incur pertaining to your home office cannot exceed your rental income, meaning you cannot use your home office expenses to create a loss. So let's suppose that your rental income is bringing you a profit of $1,000 a year, and through all your deductions, you're left with a profit of $10 in that year. But your home office expenses, let's suppose, amount to $200. You're only allowed to use $10 out of that $200 to bring you into a break-even scenario. You would not be able to write off the entire $200, creating a loss. The balance, in this case $190, would have to be carried forward to the following year. Now, your tax advisor would be able to walk you through this and help better prepare this for you. Always be sure that the people who are on your team are actually working for you. If your tax accountant isn't finding new ways and strategies to offer you tax-deductible expenses, or perhaps instead they're waiting for you to bring them up, it may be time to look for a new accountant. And remember, the fees associated to hiring a tax advisor are tax deductible as it's a business expense. However, if you prepared your personal taxes as well, you would have to exclude any personal component from the amount you're able to legitimately deduct. A strategy that we use as investors is you may choose to plan your deductible expenses. Perhaps you know that the following year your income is likely to be significantly higher than this year. Perhaps you intend to work a significant amount of more overtime, or you have a big contract lined up. You may wish to defer some or many of your purchases, such as tools or consumables, for the following year when your income level is significantly higher. This helps balance the amount of taxes that you will be required to pay from year to year. As you can see, once you have a business, it's in your best financial interest thinking and planning out your tax obligations throughout the year and not just when it comes tax season. So now what happens if you're renting the place where you live? Well, all of the tax advantages that we spoke about earlier still apply to you. However, one additional cost applies to you, which is a portion of your rent is considered to be a deductible expense based off of the percentage of use. You wouldn't deduct 100% of the cost of your rent because your home is also used to eat, sleep, relax, etc. Now, if, however, you were renting out a warehouse or an office in a commercial space, for example, then 100% of your rent and costs associated with renting out the space would be tax deductible. So now, let's suppose that you had 2 bathrooms in your house. Could you potentially be using one bathroom solely for when you're working in your home office? Let's say it's located right next to the home office, and the other bathroom perhaps is attached to your master bedroom. If this was the case, and you're only really using one bathroom anytime that you're working in your home office, it can be added to the square footage of your home office. Remember, it's worth your while to actively be looking for ways to create legitimate business expenses out of your everyday costs. Now, I know I might be rephrasing this from a previous point made earlier, but it's absolutely important to reiterate this. If you're renting your home and conducting business from it, you can deduct a portion of your rent against your total income to lower your tax burden. However, if you're living in a principal residence, a home that you own, and you want to deduct a portion of your mortgage interest based off of the consumption within the home that pertains to your business, it may be the worst thing you could potentially do. Because on your own home, you have what's called a capital gains exemption, meaning when you sell the home, the profit you make you get to keep 100% of. If you declared a business component to the house, then when you sell the house, you have to split the profit with the government in the form of capital gains. Unfortunately, we're not as lucky as our neighbors in the South. In America, you can deduct the interest paid on your mortgage, and that not only applies to rental properties, but it applies to your principal residence as well. On top of that, remember that they could claim depreciation on their principal residence to create a loss. Now, this is all thanks to their first federal tax bill back in 1913, stating that they were only going to implement a 1% tax rate on any income made over $3,000. Since only 1%, i.e. the rich and wealthy, made an income over $3,000 back then, most of America cared little and as a result didn't bother fighting the bill. Moreover, to get in the good graces of Americans, Congress decided that all consumer interest would be tax deductible. To put into other words, up until President Ronald Reagan's tax reform in 1986, you could write off your credit card interest. Of course, that has since all been changed, with the exception that you can still write off the interest on any real estate mortgage that you have in the US. This means that your Florida beach house, your multi-million-dollar mansion, or your typical and average investment property, you can write off the mortgage interest on all of them. Tenants, however, can't write off the entire portion of their rent as a tax-deductible expense. Remember, they can only write off a portion. This ultimately costs the US government over $100 billion a year in lost tax collection. So now ask yourself, the government initially proposed this to help the poor, to help people struggling, which won them votes, which kept them in power. And from that, it ended up benefiting the rich over a small period of time. To now, who does it benefit most? The rich, who owns properties. The rich, and who suffers the most? The same people that voted the bill in the first place. You see, this is a common theme throughout history and regardless of nations. When tax laws come out, they're pitched and targeted and designed to harm the rich. However, they ultimately hurt the same individuals who vote for those laws in.
Let me put another point to you, which is the notion that the rich always find a way to, legally they would say, not evade, but avoid paying more tax by being clever, whatever. They're going to move money to the Cayman Islands. They're going to hire accountants to figure out every loophole in the book. So even if you do manage to bring this wealth tax forward, it won't realize the amount of income that you think it will.
Now, this is another example of how the rich stay rich and the poor remain poor. Suppose you were to go out and get a loan to purchase business equipment, whether it be tools, whether it be materials, or Or let's say you purchased a truck specifically for your business. Now, the loan that you have on that vehicle is considered a business loan, and therefore the interest that you pay on that loan is fully tax deductible if the truck or vehicle, in other words, was purely used for business purposes. But if you were to go out and buy that vehicle with all cash, you potentially lose out on the interest that you would otherwise be able to deduct. Now, the tax deductible advantages on your rental properties apply to every investment property you own. So if you have multiple properties and each one is being used for rental purposes, you're able to deduct 100% of the mortgage interest on each of the rental properties to lower your overall taxable income. Let's talk about home maintenance fees. Remember how I mentioned Canada deterring businesses from setting up shop here? One form of that is you can't claim an expense on your own personal labor, whether it be for within your own principal residence or for one of your rental properties. Regardless of whether you're a master electrician and there's repairs needed in your home, let's say to upgrade your panel, regardless of whether you're a plumber and you need to repair a leaking faucet, the amount of time you spend on your own rental property is considered voluntary work. Now, that's assuming you're operating as a sole proprietor and not through a corporation. A corporation, however, can absolutely pay you to carry out work for your properties owned by the corporation. And that's because a corporation is considered a separate legal entity, i.e. its own person. As a sole proprietor, however, you can pay a family member a reasonable fee for carrying out such home repairs on your property. Some examples of tax-deductible home maintenance fees may include caulking around windows and doors, water fixtures, baseboards, etc., repairs to damaged screen doors and window screens, general labor, deep cleaning of your property, cleaning gutters and downspouts, unclogging any water drains, replacing your fridge water filters, conducting a furnace tune-up, washing your windows, resealing the deck, fence, or other landscape items, any paint touch-ups, and winterizing your water lines for the winter. Now, when it comes to disposal and seasonal services, you're typically charged a fee for garbage removal, whether it's carried out through a government service or a private utility company. You're able to deduct the appropriate percentage of this fee as it relates to your home business. The same is applied for seasonal services such as cutting the grass, trimming the bushes, or removing snow and leaves. As for vehicle expenses, there are a number of ways to calculate the mileage, and your accountant may advise you on which method is preferred based on your specific situation. In the event you're audited, you will need to be able to produce what's called a vehicle logbook, which should have specific information outlined in it, such as the date, the time that you used your vehicle, purpose of the trip, kilometers traveled, etc. Let's assume that 20% of your vehicle usage is to carry out business-related activities pertaining to your rental properties. Now, whether it's for serving notices to tenants, inspecting your rental properties, purchasing supplies, etc., then you could be able to claim 20% of your vehicle expenses. In the event that you have two separate vehicles, you may find it easier if one vehicle is used 100% of the time for business purposes and the other is used for personal reasons. Now, unfortunately, speeding tickets and parking fines are not tax deductible. So what are some examples of tax-deductible vehicle expenses? Gas, vehicle insurance, registration and licensing fees, financing costs, so the interest you pay on a loan, car washes, oil changes, vehicle maintenance and repairs, windshield washer fluid, depreciation of the vehicle, lease payments, tire purchases, and any other costs that you can think of that may be associated with owning your vehicle. Now, when it comes to a telephone, if you decide to set up a landline or a specific telephone line for business use, then 100% of the fees and costs associated with that line are completely tax deductible. However, if you decide to use your personal cell phone instead, then only a portion based on business usage would be deductible, and so would such fees for setting up services such as voicemail, etc. In the event any long distance calls are required to be made for your business though, 100% of those calls are fully tax deductible. In other words, you can't deduct 100% of your cell phone bill if you also use the phone to make personal calls to friends, family members, or for food delivery on the weekends. However, what you can and should do is determine what percentage of your phone is perhaps used for a business and what percentage is perhaps used for personal. Then to calculate the percent used for business from your annual phone bill amount. Now, this doesn't need to come down to a science, but it should be an honest representation, 50%, 60%, 90%. Remember, at any point in time, CRA can always ask for further documentation to support such claims, at which point you may need to be able to provide proof of accuracy for what you claim. It's a good practice to keep all important pertaining documents, even phone statements for that matter, for 7 years before disposing them. Now, here's one category people like to talk about, which is meals and entertainment. Unlike in the United States, where the entire fee is deductible for a business-related meal or entertainment purposes, in Canada, the CRA will only allow 50% of the amount to be deductible. So they'll pay for one party's meal, but they won't pay for the other. This means if you take your business partner, your spouse, your real estate agent, contractor, or the consultant that you perhaps hired for a one-on-one consultation out for a meal, and it's related to your business, then 50% of the cost is considered tax deductible. Now let's suppose that you and your spouse purchased a rental property together and both of you manage it. You both have specific roles to play in the day-to-day operation. Perhaps one of you is in charge of the administration side, such as bookkeeping or accounting. The other one is in charge of the property management aspect of your rental business. You'd be surprised by just how much of your conversations during the span of a week or a day can in fact relate to your side business of real estate investing. Now let's suppose that Shakira or Kevin Hart or any celebrity is in town and you decide to go see them. On your way, you discuss an issue that arises with a particular tenant, and the conversation perhaps likely continues well into the time that you're in your seats watching the concert. After the concert is finished, you're hungry, you decide to go for a meal, and the topic of tenants or a turnover or how to save costs or purchasing another real estate property comes to mind. So you start discussing that and go over which properties you'd be interested in adding to your portfolio, which neighborhoods, etc. Perhaps on the way home, you drive by the neighborhood and scout for any potential properties. Now you return home with the receipts for the night. You've actually just gone on a business meeting whereby 50% of the night activities are tax deductible. Now, you may raise some red flags if this was to happen on a monthly basis, but suppose this happened once or twice throughout the course of the year. Now, this might sound a little bit artificial, but I can assure you this happens a lot more than you might think. Once you become a real estate investor, you'll find that more and more of your daily conversations, thoughts, and activities revolve around real estate. Many real estate investors go into the real estate investing industry with their spouse as their business partner. Your thoughts, conversations, and activities throughout the week have a high probability to overlap with real estate in some form or another. Did she pay rent? Did he re-sign the lease? Margaret called and said the stove's not working. We need to send somebody out to fix it. Is it under warranty, etc.? This isn't necessarily a bad thing. After all, you're in it for positive cash flow and advantages that it can provide. And yes, there's going to be a bit of adjusting and legwork required. If you become quite involved in your own real estate investment portfolio, at least initially, you may come across times where your partner and you may have dinner plans or plans to go to the movies. However, just before leaving the house, you remember that you needed to post a notice on the door for a problematic tenant that you have. You decide to stop there first. Now, on the way to the movies, you're perhaps discussing issues with the property. While you're waiting for the movie to start, you suddenly start up an idea or how to address the problematic tenant. After the movies, you notice a text coming in from the problematic tenant to which you discuss the issue more with your spouse. The two of you attempt to come up with a plan of action. What started out as an innocent trip to the movies ended up overlapping with real estate and property management into the mix. Now, your movie night isn't lost, although it certainly has endured a business element to it. To compensate, the movie night therefore becomes 50% deductible. Now, granted, this might not occur every time you go out on a date with your partner, but with a larger portfolio, you'll be surprised how many times it actually does occur. You're allowed to give up to 2 gifts to the same individual if they have a connection with your business. The gifts cannot be more than $500 each, and they cannot include gift cards. So supposing you had a property manager, and once or twice a year you decided that you wanted to give them a gift out of professional courtesy. Wouldn't you suppose that that's a business expense? Or suppose you chose to give your business partner a gift once a year to show them that you value their insight and experience. Either of those cases would be a good example where a gift under $500 would be considered a tax-deductible expense. It makes no difference whether your business partner or your property manager is your spouse or a total stranger. The principle remains. Now, the timing and when you give out those gifts, if they were to fall closely in line with your partner's birthday or wedding anniversary, well, big deal. One of the advantages, however, is that the rich use these opportunities to pay for expenses that they would have naturally incurred. However, they do so using pre-tax dollars through corporations, or by simply using a sole proprietor in the above example, turning as many of their costs into tax-deductible expenses. Non-investors pay for such expenses with their after-tax dollars, and then it's lost. To perhaps put more simply, as a real estate investor, you're paying for this business night out with your spouse or business partner, but then you're claiming the expenses come tax time with the CRA to lower your tax burden against your annual income. Now, in comparison, the average Joe has his employer hold back the tax portion from Joe's paycheck, then pay Joe the balance of his salary, to which Joe now uses the money he's already paid taxes on to fund his expenses such as a movie night with his kids or spouse, etc., leaving less of his disposable income available to him. Let's go into education. There's a lot of different tax write-offs under this category. Now, education is not just limited to in-class learning. Here are some examples that can be deducted against further education. There's often information to be found in newspapers pertaining to the market, real estate, mortgages, vehicles, etc. Magazines that pertain to real estate in Canada include Canadian Real Estate Wealth, Home and Land, Real Estate Magazine, or in other words, REM, Canadian Property Investors, Canadian Property Management. The fees associated with these subscriptions and others pertaining to your real estate business are considered tax write-offs. Books that are related to real estate investing, seminars and conventions, trade shows. Now, when it comes to seminars and conventions, you need to be careful in how you approach this. If you, for example, don't own any properties and are considering purchasing a rental property, you can't deduct this cost year after year without ever purchasing income-producing properties and expect not to attract the attention from the CRA or tax department. Similarly, if all you own is your own principal residence with perhaps, let's say, a basement suite, again, you may run into some issues trying to claim this expense. On the other hand, if you have a rental property that is separate from your principal residence and you wish to make use of this expense, you'll have an easier time justifying this to the tax department. Self-employed individuals are allowed to write off up to 2 seminars or conferences per year. Now, there's a wide range of scenarios that the tax department may deem your expense unreasonable, even if you own your own income-producing property. Let's say, for example, you show a loss on your taxes for your rental property, but yet you're taking seminars and conferences out of town. CRA or the IRS might question why you're showing a $3,000 loss and taking a $4,000 trip to attend a seminar. Your expenses should be practical and relate to your overall business profitability. If you're struggling to make a profit, how can you justify creating what might be considered perhaps an unnecessary expense and showing a loss? Especially if you're traveling out of town and then staying in a 5-star hotel, for example. The seminars don't have to necessarily take place in your city, though they have to pertain to your real estate business. In Canada, the way that the CRA views seminars and conferences is that if you're partaking in either and it's to increase your knowledge base within the same industry, then it's considered to be a tax-deductible expense against your annual income. However, if you're looking at acquiring a new skill or advance your education in a different profession, then you're unable to claim this expense as a tax write-off. In addition, you have to be able to reasonably justify that attending such a seminar or convention has a reasonable expectation of driving up profits in the future. A cruise along the Bahamas would certainly struggle in achieving such justification. But now, assuming that there was a seminar in Calgary and you live in Toronto, you're able to claim the cost of travels and accommodation. However, if the seminar is from the 1st to the 3rd of the month and you decide to stay until the 5th, there would be 2 days in which the cost might not be deductible, as it might be considered personal in nature. Now, on the other hand, if you were to spend those 2 days viewing the city with a real estate agent to scout for investment opportunities, you would be able to include those days. I'm not saying that the whole day must be spent viewing properties, but perhaps 3 to 4 properties a day would be considered reasonable. Now, note that days that fall amongst the weekends in between your program are considered deductible, as it just wouldn't make sense to travel back home for the weekend and come back to the place out of town for Monday. Now, if you compare this with the United States, the entire conference cost would be considered tax deductible, and the IRS would perhaps not scrutinize if you stayed 1 or 2 extra days because you couldn't catch a flight back home. The seminar or conference is not limited to Canada, so hypothetically, if you found a conference or seminar in the States that was relative to your real estate business and operations in Canada, or vice versa, the cost of attending can be written off as an expense. Now, for Canadians, it's important to understand that there must be a component of that course that pertains to your real estate investing endeavors in Canada. If, for example, you went to Florida in the summertime to take part in a real estate course that spoke about U.S. mortgages, you would have probably a hard time justifying that to CRA that this was a business expense. Now, that's unless, of course, you owned at least one property in the United States, or perhaps you can demonstrate to CRA that you're actively considering purchasing real estate in the States. It's important to note that there's a fine line between what's related to your profession or industry and what's not. If, for example, a real estate investor wanted to take a course on construction, it would be considered acquiring a new skill and therefore would not be tax deductible. That's unless the real estate investor was already knowledgeable on construction, offering such services within his or her company, and perhaps wanted to further develop such skills. Now, here's another difference that separates Canada from the United States. The The CRA only allows you to claim up to $50 a meal for seminars or conferences. Sometimes the meals are included in the conference program itself, and therefore the cost would need to be excluded from the cost of the seminar and deducted appropriately. Just remember to keep the original receipts and invoices and any contracts or any other supportive documents. In the States, however, they don't care whether your meal came up to $50 or $52.35 or $53. They don't make a big deal out of it. You can also host up to 2 parties per year, such as a Christmas party for your business associates, and the food at such events would be 100% tax deductible. Now, you won't need to include the receipts for any of this in your tax returns. However, if CRA does come back and request for these receipts, you absolutely need to be able to produce them. A failure to produce them could potentially have CRA disallow such claims, and even worse, could potentially put you in an audit situation. Remember, you need to be able to justify and articulate why you incurred such expense and how it fits with your business plan. You should be able to explain how the expenses potentially had the opportunity to increase your income either in that current year or in the future. A business has to be able to show that there's a reasonable expectation of profit element to its decisions. Now, when it comes to miscellaneous expenses, perhaps some things that we didn't talk about, any item that has an expense associated with it that is honestly and reasonably used to service, improve, or maintain any one or all of your rental properties can and absolutely should be used as a tax-deductible expense. No expense is too small to claim. Most businesses, and sole proprietors and entrepreneurs alike, are able to significantly increase how much they claim in tax-deductible expenses without really shifting too much of their lifestyle. It has less to do with the change in lifestyle, and it has more to do with the change in mentality. Seeing expenses from the lens of business professionals instead of that of an ordinary or perhaps naive citizen. Some may struggle with this nature, perhaps out of fear that they may be incriminating themselves, or that these tax examples don't actually exist, or that they potentially don't apply to them. Now, the truth is that real estate investing is a business, and so long as you're providing a service, i.e. rentable units, expenses pertaining to the operation of your business are tax deductible. Now, that could be everything from a Dyson vacuum cleaner that you're using to clean up after your tenants vacate a unit, to the interest you pay on your mortgage. While I can certainly appreciate the intention of utmost honesty when it comes to filing taxes, as there should be, you want to be careful not to do it at your own expense. Take, for example, winnings in the casino. In the United States, you have to pay taxes on the money that you win. However, in Canada, it's tax-free. Now, imagine winning $30,000 in the casino and then being misguided and somehow believing that you had to add it to your taxable income in Canada. Could you imagine adding that $30,000 to your taxable income? Now, instead, we don't actually claim any of those winnings because that is what you're legally entitled to do. Therefore, all the $30,000 that you have profited by winning at the casino is completely tax-free. So making use of these tax deductions work and operate much in the same way, provided it's done honestly and fairly. Failing to educate yourself as to what you're entitled to claim and how can result in overpaying thousands of dollars in taxes, much in the same way claiming any kind of winnings that you receive in the casino can. Now, understand something here. I by no means am suggesting that you drum up fraudulent expenses. However, you should make it a priority to understand and identify all the tax advantages that may apply to you currently and or in the future. It literally pays to know. Critics are bound to claim that tax avoidance strategies only hinder the community because it draws money away from social services, programs, or infrastructure, etc. Now, I would argue that you're still paying your fair share in taxes. The key word here is fair. Nothing more, nothing less. And that's where you should aim to be. After all, we have seen time and time again just exactly what the government thinks of our tax dollars. The previous Prime Minister, Stephen Harper, is reported to have spent $45,000 in taxpayers' money to travel to New York for a 2011 Labor Day weekend to watch the Yankees play baseball for his daughter and his guests. Now, shockingly enough, this included a $34,633 cost of using a Challenger jet and over $10,000 in expenses of 4 staffers. Only after public scrutiny was this amount ever repaid. The Department of National Defense spent $15,000 in 2013 on a public survey. So what was the survey on? Whether Canadian forces played an influential role in foreign aid in the recent years? Or perhaps whether Canadian soldiers were appropriately being cared for after returning from war with PTSD? Or maybe it was about whether government aid was being given to our troops to acquire civilian jobs after leaving the armed forces. No. The $15,000 survey asked participants whether superheroes from comic books could jump over skyscrapers. Now, just consider that Justin Trudeau took his family on a trip to India totaling 8 days in 2019 for a whopping $1.66 million. This trip consisted of only half of a day in government business on his itinerary, but did, however, manage to include a chef from Vancouver paid to cook for the family for a fee of $17,000. Believe it or not, this is actually an improvement from Stephen Harper's trip to India in 2012, which cost the taxpayers $2.5 million. In 2017, you may recall that the City of Toronto estimated the cost of building stairs at a city park to be between $65,000 and $150,000. Now, a Toronto man took it upon himself to build those same stairs with the contributions of a few community members for a total of just $550. Thank you guys for taking the time to watch my video. I hope you liked it and I hope you learned something. If you did, hit the like and subscribe button down below. It helps me to grow my channel and continue putting out great content for you guys. Leave me a comment in the comment section below. I'd love to hear from you.